The four most important stocks right now and what they're really worth. 2026. As of March 2026, the market is dominated by a handful of companies that are not just large, they are shaping the entire global economy. Right now, the most talked about names are Nvidia, Apple, Microsoft, and Amazon. These companies dominate market cap rankings, with Nvidia alone approaching $4 to $5 trillion valuation, leading the world. But here's the real question. Are they still investable today, or are we looking at peak hype? Today, I'm breaking down each company using a DCF framework with base, bull, and bear cases grounded in the latest developments. Over the past few days, Nvidia made one of the boldest statements in corporate history. Jensen Huang is projecting $1 trillion in AI hardware revenue to 2027. That's double the previous $500 billion forecast just months ago. And importantly, this is just AI chips, not total company revenue. Let that sink in. No company in history has ever generated $1 trillion annually, and Nvidia is saying, we see that demand coming. Even more telling, they already have visibility into $500 billion plus in orders. Quarterly revenue has exploded to around $68 billion per quarter recently. This is not hypothetical demand. This is already happening. If you still think Nvidia is a chip company, you're behind. Nvidia today is 3 layers of monopoly power. 1, hardware monopoly, GPUs. They dominate AI training and inference. Blackwell, current generation. Rubin, next gen 2026 plus. And full-stack systems, not just chips. There is no real alternative at scale. 2, software lock-in, CUDA. This is the real moat. Developers build on CUDA. AI models are optimized for Nvidia. Switching costs are massive. This is why competitors struggle, even if their chips are good. 3, full AI infrastructure stack. Nvidia now sells chips, networking, data center systems, and AI software. They are becoming the AWS of AI infrastructure, but with higher margins. Here's the part most retail investors underestimate. AI is not a product cycle, it's an infrastructure cycle. We are talking about trillions in data center spending, governments and hyperscalers racing, energy and compute bottlenecks. Even Nvidia's CEO said the world will need trillions more in AI infrastructure. This is why revenue is exploding. Current financial reality. Let's anchor this in numbers. FY 2026 revenue estimate is around $200 billion plus. Gross margins are 70 to 75%. Data center is the dominant segment. This is insane profitability for hardware. Normally, hardware commoditizes. Nvidia is doing the opposite. Now let's strip away the hype and quantify it. Base case, AI strong but normalizes. Assumptions, revenue CAGR 25% next 5 years, operating margin 45%, terminal growth 4%. This assumes AI demand continues, but growth slows as market matures. Intrinsic value around $4 to $4.5 trillion. This roughly matches where the stock trades today, meaning the market already prices in a strong future. Bull case, AI supercycle. This is what the market is quietly betting on. Assumptions, revenue CAGR 35% plus, software and platform monetization kicks in. Nvidia captures majority of AI spend. This aligns with $1 trillion AI revenue projection, hyperscaler arms race. Intrinsic value, $6 to $7 trillion. This is where Nvidia becomes the most valuable company in history, by far. Bear case, AI reality check. This is the risk nobody wants to talk about. Assumptions, growth slows to 10 to 15%. Hyperscalers build their own chips. AI ROI disappoints. Important context, some reports already suggest AI ROI is unclear for many companies. Intrinsic value, $2.5 to $3 trillion. That's a 30 to 40% downside scenario. It's not competition, it's demand sustainability. Right now, AI spending looks like this: Microsoft spending aggressively, Amazon massive capex, Meta billions per quarter. But ask yourself, what happens if they pause, even temporarily? Because Nvidia's valuation assumes continuous exponential spending. If that breaks, even for 1 or 2 quarters, this stock does not drift down, it reprices violently. You are not buying a company, you are buying the continuation of the AI boom. Nvidia will either become the backbone of a trillion-dollar AI economy or the most crowded trade of this cycle. Now let's talk about the company that might actually win the AI race without the hype. That's Microsoft. While everyone is focused on Nvidia's explosive growth, Microsoft is doing something more important. It is turning AI into recurring revenue at scale. Over the past week, Microsoft made a major internal move. They merged all Copilot teams into one unified structure. Leadership is now directly reporting to CEO Satya Nadella. At the same time, they are doubling down on building their own AI models. This tells you one thing: Microsoft is not satisfied being a distributor of AI. They want to own the full stack. But here's the reality most people are missing. Only about 15 million paid Copilot users today, out of 450 million Office users. That's tiny penetration, which means the upside is still largely untapped, but monetization is not proven yet. If you think Microsoft's AI story is Copilot subscriptions, you're underestimating it. Microsoft has 3 engines working together. 1. Azure, the real money machine. Azure is the core. Azure growth, 39% YOY. Cloud revenue, $50 billion per quarter. This is where AI actually monetizes: training models, running inference, and enterprise workloads. And here's the key insight: every AI company needs compute. Microsoft charges them for it. Number 2, enterprise lock-in, the real moat. Microsoft owns Office, Teams, Windows, and Dynamics. This is critical, because instead of selling AI as a product, they embed AI into tools companies already pay for. Example: Copilot in Excel, Copilot in Outlook, Copilot in Teams. That's not optional software, that's workflow infrastructure. Number 3, OpenAI partnership. Double-edged sword. Microsoft owns about 27% of OpenAI, and OpenAI is deeply tied to Azure. Massive cloud contracts, revenue sharing model, AI demand driver. But here's the risk: 45% of Microsoft's backlog is tied to OpenAI. That's concentration risk. If OpenAI weakens, Microsoft feels it. Let's ground this in numbers. Latest quarter, revenue $81.3 billion, plus 17%. Operating income $38.3 billion, plus 21%. Operating margin nearly 47%. This is absurd. Let me translate. Microsoft is scaling AI while keeping elite profitability. Even more important, CapEx $37.5 billion in a single quarter. They are spending aggressively, but they can afford it. Here's the uncomfortable truth: AI adoption is strong, but AI monetization is still early. Evidence: Copilot adoption is low relative to user base. Some surveys show weak retention versus competitors. And here's the bigger issue: AI is expensive to run. ROI is still unclear for many companies. So the real question is, will enterprises actually pay more for AI long term, or will this become a cost center, not a profit driver? Now let's strip the story into numbers. Base case: steady AI monetization. Assumptions: revenue CAGR 12 to 14%. Azure continues strong growth. Copilot adoption gradually increases. Margins stable with slight expansion.
Intrinsic value, $3.2 to $3.5 trillion. This is the nothing goes wrong scenario. Bull case, AI becomes default software layer. This is where Microsoft wins big. Assumptions, Copilot becomes standard across enterprise. Pricing power increases. Azure dominates AI cloud. Key insight, even modest adoption can be massive. Example, $30 a month Copilot, 100 million users, $36 billion annual revenue. High margin, recurring revenue. Intrinsic value, $4 to $4.5 trillion. Bear case, AI hype, weak monetization. This is the real risk. Assumptions, enterprises resist paying for AI. Copilot adoption stalls. AI costs compress margins. Plus, competition from Google, Anthropic, dependency on OpenAI. Intrinsic value, $2.2 to $2.6 trillion. The key difference versus Nvidia? This is critical. Nvidia sells the shovel. Microsoft sells the subscription on top of the shovel. That means Nvidia is cyclical with demand spikes. Microsoft is recurring and sticky. Here's the blunt truth. Microsoft is not the most exciting AI stock, but it might be the highest probability winner. Because Microsoft doesn't need AI to be perfect. It just needs enterprises to keep paying subscriptions. If you think like a long-term investor, Microsoft is a compounding machine. AI is an incremental upside, not the whole story. Microsoft doesn't need to win AI. It just needs to own where AI gets used.
Now let's talk about the most misunderstood company in big tech right now, Apple. Because Apple just reported one of the best quarters in its history. And yet, the market isn't impressed. That tells you everything. Let's anchor this in facts. Apple just posted $143.8 billion in quarterly revenue, plus 16% year over year. $42 billion net income. iPhone revenue, estimated $85 billion, plus 23%. Services revenue, estimated $30 billion, plus 14%. Gross margin, estimated 48.2%. This is not a weak company. This is elite performance. And yet, the stock barely moved because investors are forward-looking. And here's the uncomfortable truth. Apple's future looks very different from its past. Let's be brutally honest. Apple is still an iPhone company. iPhone equals 50% of total revenue. Growth comes from upgrade cycles, not new markets. Yes, the latest quarter was strong, but zoom out. iPhone unit growth has been mostly flat for years. Growth comes from pricing, not volume. That's not scalable forever. Now here's where Apple actually shines. Services is estimated $30 billion quarterly revenue, 70+% gross margins. That is insanely profitable. Products, iPhone, Mac, etc., estimated 30 to 40% margins. Services, double that. This is why Apple keeps pushing App Store, iCloud, Apple Music, and payments, because this is where the real money is. Now let's address the elephant in the room. Apple is behind in AI. While competitors are building models, selling enterprise AI, monetizing infrastructure, Apple is still figuring out its AI strategy. Recent developments show AI-powered Siri delayed, partnerships like external AI integration, and acquisitions to catch up. This is not leadership. This is reaction. Here's another issue no one talks about enough. Margins are at risk. Rising memory costs could hit margins by 140 basis points. Apple has historically protected margins well, but hardware plus rising input costs equals pressure. And unlike software companies, Apple cannot just scale margins infinitely. Now let's strip away emotion and run scenarios. Base case equals stable giant. Assumptions, revenue CAGR 5 to 6%, services grow steadily,
iPhone remains dominant, margins stable. Intrinsic value equals $3 to $3.5 trillion. This is where Apple sits today, meaning the market sees it as a mature company. Bull case equals new product cycle. This is what Apple needs. Assumptions: breakthrough product, AI device or spatial computing. Services accelerates, AI finally monetizes. Think new iPhone supercycle or entirely new category. Intrinsic value equals $4 to $4.5 trillion. But here's the issue. There is no clear catalyst yet. Bear case equals slow decline in relevance. This is the risk nobody wants to price in. Assumptions: iPhone stagnates, services growth slows, AI competitors pull ahead. Intrinsic value equals $2.2 to $2.8 trillion. Not collapse, but multiple compression over time. People think Apple is a growth stock. It's not. It's a capital return machine. Massive buybacks, huge cash flow, stable earnings. This is closer to a high-quality consumer staple, not a hyper-growth tech company. Here's the blunt truth. Apple is one of the best-run companies in history, but also one of the least exciting today. You are not buying innovation. You are buying stability, cash flow, buybacks. Apple doesn't need to win AI, but if it doesn't participate meaningfully, it slowly becomes irrelevant in the next tech cycle.
Now let's talk about the company the market keeps getting wrong, Amazon. Because right now, Amazon looks messy. Massive spending, margins under pressure, stock underperforming. But under the surface, this is one of the strongest long-term setups in the entire market. Over just the past week, AWS is now projected to hit $600 billion annual revenue long-term, driven by AI. Amazon is spending $200 billion in CapEx this year, mostly on AI infrastructure. They're building their own chips and partnering with companies like Cerebras to compete directly with Nvidia. Despite all this, the stock is down this year due to investor fear. This is the key disconnect. The business is getting stronger, the market is worried about spending. Most people think Amazon equals e-commerce. That's outdated. Amazon today is three businesses stacked together. One, AWS, the real driver. AWS is the crown jewel. Q4 revenue $35.6 billion, plus 24% year over year. Annual run rate approaching $140 billion plus. Backlog $244 billion, plus 40% year over year. This is not slowing down. It's accelerating because of AI. Even more important, AI companies are locking into AWS. Example, Anthropic expected to generate $15 billion plus AWS revenue in 2026 alone. This is recurring, high-margin demand. 2. Advertising, the silent profit machine. This is the most underrated segment. $21 billion quarterly revenue, 22% growth. And here's why it matters. Ads have software-like margins. Every product search on Amazon? Monetizable. This is basically Google search, but at the point of purchase. 3. E-commerce, the cash flow base. This is the part everyone complains about. Low margin, logistics heavy. But here's the truth. It funds everything else. And it's still growing. Total company revenue trending toward $170 to $800 billion annually. Plus, pricing advantage versus competitors. Massive global logistics network. This is not dead. It's just misunderstood. Here's what the market is missing. Amazon is not chasing AI hype. They are building the plumbing of AI. Key pieces, custom chips, Trainium and Interentia, AI platform, Amazon Bedrock, cloud dominance, AWS. And here's the strategic edge. Amazon is focused on cost efficiency. Claims up to 40% cheaper AI compute versus Nvidia. That matters. Because long-term, AI becomes a cost game, not just performance. Let's not sugarcoat it. Amazon is spending aggressively. $200 billion CapEx in 2026. That hits free cash flow, margins, and investor sentiment. And here's the risk. If AI demand slows even slightly, these investments look excessive. That's why the stock is lagging. Now, let's break this into scenarios. Base case, steady compounder. Assumptions, revenue CAGR between 12 to 15%. AWS continues strong growth, adds scale. Margins gradually improve. This means intrinsic value of $2.5 to $3 trillion. This assumes AI demand remains strong, but normalizes. Bull case, AWS plus AI dominates. This is where things get interesting. Assumptions, AWS becomes dominant AI cloud. AI workloads explode. Ads plus cloud margins expand significantly. Remember, AWS alone could reach hundreds of billions of dollars in revenue. This makes intrinsic value of $3.5 to $4 trillion. This is where Amazon becomes a full-stack AI and cloud monopoly. Bear case, spending without returns. This is the real risk. Assumptions, AI ROI disappoints. CapEx remains high, margins stay compressed. This means intrinsic value of $1.8 to $2.2 trillion. Not a collapse, but years of dead money. If you force me to rank based on risk versus reward, Microsoft is the best balance. Amazon, upside hidden. Nvidia, great, but expensive. Apple, defensive. The market right now is not about diversification, it's about being right on AI, cloud, and automation. Because these four companies, they aren't just stocks, they are the market. As always, this is simply a record of my own investment journey and portfolio decisions, not financial advice. And if you enjoy these investment diary updates, consider subscribing because I'll continue sharing real positions, real numbers, and the reasoning behind my long-term investment strategy.